Hi everyone, and welcome to another FX Lounge event. Today we're going to be discussing how to be profitable at trading channels. And we're going to be specifically looking at the pitfalls that a lot of people make when trading channels. And we're also going to be looking at a couple of things that you can do to increase your profits when trading channels. So I've also got Tyrone here again today.
Hi everyone.
And this is of course episode 2 or week 2 of the FX Lounge. So thanks for joining us again.
And thanks everybody for all of their comments and emails of support last week. We've got a couple of questions that we're going to address a little bit later on that we had during the week. So again, keep them coming.
Yeah, it should be really good. So just to start, like last week, we need to go through a risk disclaimer. This presentation documentation is purely for educational purposes, and the information in this presentation documentation is of general nature only. So it doesn't take into account your specific needs or circumstances, and you should always check with a financial advisor or financial decisions and seek independent financial advice if necessary. So just always need to go through that. Now, what we're going to be covering today is a couple of different things. We're going to be looking at theory similar to last week, then we're going to be looking at some real examples, and then we're going to be taking a look at the live market. So every week with the FX Lounge, the way we're going to set it up is that we're going to find what we're seeing in the market and also what you are sending us in. And then we're going to look at the theory to give beginners a bit of knowledge about how to correctly trade stuff. And then we're going to be breaking it down to some real examples in the past and then looking at the actual live market. So that's why it'll constantly be flowing through different topics. But we're going to start today with channels. So what is a channel? Here we've just got a line chart. And you can see that price is being trapped within 2 points over time. And this is after a certain period of time where price is trapped, us as technical traders will be able to actually identify this and call it what we call a channel. So you can see we've drawn our support line down the bottom, and many people will be familiar with what support means. Basically means a level where price has not been able to break to a new low. And then you can also draw your resistance level at the top, or a level where price has not been able to make a new high. And after the first touch, we can probably start drawing these lines. And then on the second touch, we can draw these lines for sure. And then the distance between these is our channel distance. So it's what's called a horizontal channel. And I found a live one with Tyrone just before this session on the Australian US dollar. So I'd really like to discuss that today.
Perfect. And the live examples will show us that channels obviously aren't always as pretty as they are on this slide. And you'd have to make some allowances. Sometimes they are sloping up a little bit, and sometimes price does break through the low or the high by a little bit. But we will talk about the fundamentals of what to look for inside the channel as we go through.
Yeah, so with channels and correctly analyzing them, the most important thing for anybody to do is to make sure that there's at least 2 touches on each side, and that then validates the channel. So whenever you're looking at technical analysis, remember there's always a valid way of looking at a pattern or a particular support resistance line. There's always a way of having hard, fast rules and when to draw them. So for a channel, it's 2 touches. So the first touch, the second touch, and after the second touch, I usually like to wait until it potentially comes back into that middle zone, and then I'll draw these 2 lines.
Absolutely. And the thing with validation is that if you do see 2 touches on both sides at the support and the resistance, what it is giving you the confirmation is that a lot of people are probably starting to see it. A big flaw in a lot of trading techniques is seeing something that nobody else is. So by validating the support and resistance with a couple of touches on each side, we're basically saying, okay, we are not the only ones seeing this channel. There are millions of people around the world seeing it all at the same time. And consequently, the channel should hold and the patterns will be traded inside it. So it's not just you seeing something that nobody else is. Because obviously, the trick to trading is to actually go with where the majority of traders are going.
Yeah, it brings me back a little bit to when I used to work in retail, and they had a term called KISS, which was keep it simple, stupid. And I think it really is very important to think about something like that when you're trading. As Tyrone said, the most important thing is how many other people are seeing your pattern. Because if the big money's seeing your pattern, so that being the hedge fund managers and the big traders and the banks, then it's probably going to work out and become a self-fulfilling prophecy. So with a channel, the general consensus is that once you've had your 2 touches, you can validate it. Then what you're looking for is you would be, if you're trading within the channel, you'd be selling as it comes to the high and buying as it comes down to that low. So when it comes to our bottom end of the channel, we'd buy with the idea of price increasing over time and then going into the top end of our channel and us closing it. And when it came back in up to the top, we would then sell it with the idea of price decreasing back into our buy zone. So we could technically do this, well, I guess, as many times as it happens. It could happen a lot.
Exactly. And the thing is, nobody can really determine how long a channel is going to last. So you trade every opportunity that you get inside it. And as long as you're using the correct risk management, of course, at some point it will fail to the downside or to the upside. But again, that will bring about another set of opportunities, which we'll talk about a little bit later on.
So just again, take profit when price hits the opposite side of the channel and then reverse. And with the stops, I would usually place the stop losses. So when I entered, let's say the buy, I would place it below these points here. Generally, if there's a little bit of a wick, so a little bit of sometimes these channels aren't perfect, and we'll see some later. If it's gone a little bit lower, you'll place the stop just below that, and they can be quite high risk, high reward, low risk trades. So pretty good little trades.
Absolutely. And you might ask yourself, how long will a channel go for? But of course, another thing that has to be considered is what time frame that channel is in. So as predominantly a lot of our trading is done in stocks and mutual funds. So when we look at daily and weekly charts, sometimes these channels can last for years. Like we've seen examples where a good solid channel has lasted 2 or 3 years. So the trading opportunities are all relative to what time frame you're actually trading it in. So
and they will work on any time frame. So you could be trading on 1 minute chart. Well, try not to do that, but 5 minute, 15 minute, 1 hour, daily, 4 hour. It doesn't matter. If you're seeing the channel on that, it's valid in that time frame, and then whoever's trading that time frame will generally be trading within those. So let's take a look at channel breaks quickly before we get started on a couple of live examples. So here we have our validated channel, and of course at some point price is going to probably break out either to the upside or the downside, and we may not know which side it's going to move out to. But when it does break to a side, let's say the upside in this case, it creates a buying opportunity for us as technical analysts. So we can actually buy this zone, and then we can place a stop loss very conservatively if we want to down the bottom here, or we can place it below the last swing. So we can place it below the last high within a trough or a low, and then it makes a new high. That would be where we place it. And we'll look at that later on the live charts. So with channels, just like any pattern, we can actually analyze the distance between the top and the bottom of it, and then we can make that our take profit area. So whatever the channel's been generally moving within, so this range usually works out to be the next range that price will break to. So price will break up. The idea is that we take profit at the distance, so the distance here, and we're going to see how that works in a couple of live examples we've got in a couple of minutes. But that's how you do it. So you'd always buy, and then you'd either place a stop loss below the last low or the swing.
Absolutely. And when we go to the live example, we'll see what really constitutes a good break of the channel.
So let's do it. Let's go take a look at what we're seeing on the Australian US dollar. So we've got our Pepperstone charts here. We've got an Australian US dollar pair on the daily charts. I'll just get rid of this so everyone can see it a little bit clearer. Now, I've just gone in, and I like to draw my support resistance lines, at least initially, with a line chart, by the way. So I like to use line charts. It just becomes a little bit more clear. And the reason why is line charts are the close price. So usually it kind of creates less noise. And if you can see a pattern or you can see something like this on a line chart, it means it's a little bit more solid than just looking at, let's say, a candle chart and seeing wicks. So seeing those like price points where prices come down and then fully rejected that area and done that multiple times. So I like to do line charts, and then I'll draw what I'm looking at. So here we have, I guess, the channel that I've been looking at on the Australian US dollar. So you can see the price has come down, hit the 69 area. It's then gone back up and hit 73.5. It's gone back down, hasn't quite got to the bottom, but then it's gone back up, hit the 73.5 again, and then come back down to the 69, and then gone back up and actually broken to a new high. So we're here looking at this saying, okay, if we were selling and buying within the channel, well, that's not what we're looking at anymore, but we can see that prices made a significant new high past our channel, and we could actually take the distance between this channel and then set that potentially as a take profit area if we were to buy the Australian US dollar. Tyrone, have you got anything to add quickly?
Yeah, absolutely. I mean, obviously, this is a good example of a channel that has held a couple of times on both ends. But what actually makes this channel a good channel is the candle that did break through. As you can see, is a very strong bullish candle that closed well above that point of resistance. Okay, so initially, it's not the perfect channel break because it did actually travel a considerable distance before it actually closed. Okay, so we would never enter a channel break until we had a confirmation close on that candle. So the fact that this candle went nearly 100 pips is a little bit annoying. But in saying that, we have got another opportunity to enter this trade because as you can see, price is starting to retrace. And another good method of entering a channel break is actually on the retest of that zone. So like we learned basically last week, resistance can become support once it does eventually get broken through. So what we would be looking for here is buying at the maybe the 73.50 zone, which is where we had our initial resistance. So we've actually got a good base to buy from now. Okay.
Yeah, what I've done is just while Tyrone was talking, I've actually just drawn a Fibonacci of the previous move or of this move here. And you can see that if price was to come back down into the previous highs of the channel, it would be around that 382 Fibonacci retracement. So sometimes if you draw things and then they all add up together, that could mean that it's a good trade to be in. So this zone here that I've just got the pointer on, it could be a good buy zone. And then of course, by using the take profit area, we'd be looking at potentially exiting around here, which is about 78 Australian US dollar. So what I want to talk about with Tyrone today and with you guys is what the potential pitfalls of trading this trade would be. So what do we need to watch out for before it even happens? And also, where do we place our stops? Where do we potentially set the take profit? Do we set it at the maximum? Do we not? So what I'd like to do is, firstly, if we were entering the trade, let's say we waited for the trade to come back down and hit this level here, we'd need to know where to place our stop loss. So our stop loss, I would place behind the last swing. So I'd place it just down here, below this last swing. So it's where it came down and then it broke to a new high and it came back up. So that would be the first thing that I'd do when entering this trade. And you can place the stop loss below here, but it won't work out risk reward wise. Let's get rid of this. 1 second, sorry about that. So the way that I would be doing that would I place my stop loss here, I'd enter into the Australian US dollar, potentially buying here, and then I'd be looking at how do I manage the trade. So I might want to set the take profit for here, but I also know that it may not work. I mean, this kind of trade probably works around 70% of the time. So if it works 70% of the time, how do we still mitigate our losses if something was to occur? Well, through support resistance, if we look over here, you can see a point where prices come down. Let's go back to a line chart. Prices come down several times and hit this low point. And what we can do is we can draw a support line across here, and you can see that this could potentially be the first level or first area to be concerned about when it comes to trading this. There'll be a lot of sellers here. So we're in a strong Australian US dollar downtrend overall. So there could be a lot of people looking at selling the Australian US dollar at around this 76 cent mark. So what I would do is that if it came down here and then it broke to a new high, so it came up and broke to a new high, I would probably look to break even the trade.
Absolutely. At the very least, you would break even or take some profit off the table. But that line that we've drawn there was basically providing support on a very strong downtrend for the best part of nearly 5 months. Okay, so it is a serious level of support. So the fact that it gave so much support is probably a good indication that it's going to give a fair amount of resistance actually on the way up. So it would be a very, very sensible move to at least take some profit off the table at that level, knowing that we are going to have a significant headwind getting past that zone, which is about 75, nearly 76 US cents. Okay. Now the fact that we've had a decent break now, and we've gone a good 80 or 90 pips past our resistance line, means that our entry point is going to be on a retest, or what some people call a throwback to the resistance. Okay, so that gives us a little bit more confidence in where we can put our stop, because if we were trading the initial break, we would probably need to give our stop a little bit more room, because it is an initial break and it does have a chance that it may be what we would call a fake out. But the fact that it's broken past there now, we know we're going to find at least some level of support when it does retest that zone, which means that putting the stop just below the last swing makes a lot of sense. So I think Thomas is actually setting up the trade now.
Yeah, what I'm doing is I just wanted to set up and show everyone an example of, let's say we do enter this trade, how I might do it. So this is, of course, a demo, so don't go out there and just trade this for any reason. Of course, it's just general advice. But
You've heard it first. The Aussie dollar's going to 78 cents.
Yeah, definitely not a guarantee. But as technical analysts, we should be looking at these opportunities. So let's say we place an order here to buy. What I'd be doing is I'd probably be placing 2 orders to buy, and I'd be splitting my risk between those 2 orders. So like Tyrone was saying, this could definitely be an area where I would expect some sellers to come in. So how I like to manage a trade is, let's say we're just risking 1% of our, and let's just say 1% was $100. I would be placing $50 risk on one trade and $50 risk on the other trade, and I'd probably set one to have a take profit at this point. I'd have the other one as a take profit of, I like to set for about 80% of the move. So around here, around 80% of what we expect to happen, because you'll notice that whenever you're trading in the market, it doesn't always reach the perfect amount. It usually reaches a little bit less. And so 80% is a really good mark. And that when the trade, let's say it came back down here, and I'll draw this for everybody. Say it comes back down here and then breaks to a new high. When it breaks to that new high, I'd break even the second and the first trade, and I just leave it in. So hopefully you'd have one that was absolutely a success and comes here, and then the next trade would be already broken even. So regardless, we've taken some profit off the table, and the rest we're letting hopefully create more profit for us later on. So I always like to have 2 orders, and I usually have ways of managing them when I'm looking at trading live.
Absolutely. And what that also does, it actually gives you a little bit more comfort in letting the second trade run. Now, I know as traders, most people would be guilty of pulling the trigger a little bit early and not letting a trade, fulfill its full potential by, seeing it reach maybe 50 or 60% of its initial target. But the only way you can advance as a trader and become, even more successful, or even potentially make it a career, is to absolutely let trades run to their full potential. So by halving your trade and taking some profit off the table and taking the majority, if not all, risk out of the second trade, you'll see that your trade plans a lot of the time will work out for you, and you'll have a lot more confidence in actually leaving them in, which is obviously the key to being a successful trader, letting your profits run.
Probably one of the most important things what Tyrone just said there, having the confidence in your trading system, and also having this kind of dual tier, I guess you could say, trading system where you take some profit at the first zone and some profit at the second zone, will give you the confidence, because you've already taken some money off the table, that regardless of whether the trail fails or succeeds after that, you've still made some money. So it just gives you that psychological edge. And everything in trading, or at least 40 or 50% of trading, is that psychological edge. Can you stay in the trade? Can you be true to your trading system? And I'm sure many people can remember, probably even in the chat right now, where they've been awake at 10 o'clock or 11 o'clock at night, and they're kind of looking at trades, and then all of a sudden they place a trade and with the idea of taking 100 pip profit, and then 15 pips later they're like, oh, okay, I've made enough money, I'm taking it out. That's not a trading system, and if you keep doing that, you won't generally be successful because you're not playing the statistics and you're not playing the percentages. And really trading comes down to statistics and percentages, especially when you're technical.
Absolutely. And just as much as this pattern is obviously a very strong pattern, what we've also got here is a third confirmation in that our profit target is also the same length as this initial move, and you'll find it's also the same length as that one. And
that's by coincidence, by the way, because that's just 80% of the move.
Yes, but it is actually something that I've just noticed now. So I'm going to include it because we will talk about this in coming weeks. But the market does often move in 3 waves. Okay, so you can see here that we've already had the one wave. This is the second wave, and by coincidence,
if it does come down here,
our projected target will be a third wave, which is equal to the first 2. So
just a little bit of extra confirmation there. It's good.
And there are other people, who aren't even seeing this channel who will trade just waves like that. So you're basically getting on board with 3 or 4 different methods to trade this Aussie dollar long.
So I will go back to the live chart soon, but I just want to talk about candle patterns a little bit with everybody. And I want to specifically look at hammers and shooting star patterns because they can be used inside of channels to actually help us to find really good areas to buy and sell. So some people will be familiar with these, but bear with us if you are, and we'll go to some live examples after this. So the 2 bullish patterns here are bullish engulfing and hammer, and then we've got the bearish, which is bearish engulfing and shooting star. We won't be covering bullish engulfing and bearish engulfing today, but they can be used in channels, so you can check that out online if you'd like. But hammers and shooting stars we will be looking at. So what is a hammer? A hammer basically is the signification of the potential of an end of trend. So what we're looking for is we're looking for a rejection of price from a critical point. So in a hammer, it's always a bullish signal. So what we're looking for is a price to come down throughout the length of the candle. Then at some point, the sellers have stopped, having control of the candle, and then the buyers have come in at some point during that and pushed price all the way back up, and actually price has ended at a higher point. So you can see how the body of the candle is usually quite small in relation to the wick or the long area where price has been rejected from. So we'll just highlight that.
Yeah, and as you can see, when you're looking at candles and looking for a signal from what the candle is doing, we have to look at what the candle is trying to tell us. Okay, so if we look at this candle in particular, we've got an open here, which is basically quite lower than the previous candle. So we're certainly still in bearish mode at this point in time. But the sellers have just completely overwhelmed the buyers for the majority of this period. Now, it doesn't matter what candle this is, whether it's a daily candle or a 4-hour candle. The period is relative to whatever candle we're looking at. Okay, so it wouldn't matter which period we're looking at here. It could be a weekly candle. But for the period, the sellers have basically overwhelmed the buyers. But at some point throughout this period of this candle, the buyers have just come in and completely won back control. And not only have they beaten the sellers at what they were trying to achieve, but they've actually pushed it to a higher point than when it actually opened. So what began as a very bearish candle has ended up a very bullish candle, just purely because of the fact that the buyers have just completely overwhelmed the sellers at the closing period of the day. Okay, and that is why it's basically a reversal candle, because the buyers have assumed control.
Yeah. So hard fast rules, because as technical traders we always want hard fast rules. Bottom shadow needs to be at least more than twice as long as the body. So it's really important this shadow area here is at least twice as long as the body area. You're not always going to see perfect ones like this though. So let's just quickly take a look at one in the market. It's actually a perfect one. But this is on the Euro US dollar 4-hour. And you can see how price has come down steadily over time. And this was taken back in 2012, but there's plenty of examples out there. And price has come down. It's then had this hammer rejection, and you can see how strong the move was after it. So the sellers have had control the whole time. Then they've reached this point, and the buyers have gained control strongly during this candle. It's rejected, caused a hammer, and after that, strong buying occurred. So be very happy if we got in here. And then, of course, we saw nice green candles like this. And you can see that it looks like trend actually completely switched from this selling point here, and it switched to a buying trend, so an uptrend, and it continued on. So they can be quite powerful, and you can see some imperfect ones. That's why I picked this example. You've got an imperfect one here, and then you've got one that actually didn't quite finish above, but not everything's perfect in technical analysis. So this is another good one as well.
Absolutely, and although that is red, basically meaning that the close was still a little bit lower than the open, that is still a very bullish candle. I'd be ignoring the color of that body. And
sometimes you've got to ignore color, but
put that. I mean, when you put things in perspective, if we drew a support line and a resistance line here, right through there, you can see here that prices pushed past a point of support that would have been previous support. It's completely rejected it, which is meaning it is now ready to go. And you've got 3 reasons to be buying that zone.
Okay, well, let's take a look now. I've just highlighted these ones for you, but of course there's kind of an imperfect one here as well. So let's take a look at the shooting star. So everyone's probably already realizing shooting star is the reversal of the hammer. It's looking for a change of trend to the bearish side or the selling side, and it usually signifies the end of a bullish trend or uptrend. So the up shadow again needs to be more than twice as long as the body. You can see it is here. And if we look at an example, it's very glaringly obvious, but I'll highlight it anyway. And this is the Australian yen 4-hour chart again. Now, I like 4-hour charts. I'm a bit biased towards them, but 1-hour charts, daily charts, 5-minute charts, 15-minute charts, it doesn't matter which chart you're looking at. These will still carry a lot of weight just by themselves. So if you were just trading hammers and shooting stars, you could actually be statistically profitable. I've done the math on it, or at least I've done as much analysis as I could over 7 years. I looked through everything and went through all the charts and labeled all of them, and it does look like if you focus on fairly good looking ones, especially in trend, that is actually a profitable technique by itself. But as technical traders, we want as many many different options as possible, and we want to try to put together a picture. So what we're going to do is we're going to do that now, and I'd like to do that on the Australian US dollar that we were just looking at before. So here's the Australian US dollar, and some of you might be seeing it. If we have a look onto the smaller time frames, let's go to an hour time frame. We'll just have to zoom this out a little bit. I think it was an hour time frame. It's not exactly on the top here, but you can see these rejections that are around in different points. So here's one here, and then we've got a bit of a rejection here coming in, and then we've got rejections here. So you can see these hammers and shooting stars occurring. And I do have one on the euro pound that I had from a channel, and I wanted to show you guys how it can come. Here it is here, and how it can be on the bottom end of the channel. So here's our support line, and you can see here it is, a slightly imperfect one, but there's an imperfect hammer, and it's also coming onto the bottom of our support line. So we've got our support line, we've got a hammer, we're already looking at buying. If we're coming in and looking at the charts without being able to see anything else, it's a really good buy zone, and it's giving us that extra confirmation. So you'll see it happen a lot, especially when you're trading channels, and it's why I want to pick that out for everybody today. So when we're looking at channels, we'll be checking out the channel. We'll actually see sometimes this happen, and that gives us that extra confirmation that's probably going to work out.
Absolutely, and channels is one of those patterns that obviously relies on support and resistance as its base. So a shooting star or a hammer in isolation are quite a powerful candle setup anyway, but when you combine them with the relative support or resistance at that level as well, it just increases its power 2 or 3-fold. In fact, a lot of the time I don't even trade a shooting star or a hammer without some sort of support or resistance to back it up. That's purely just a preference thing. But when you do have the support and resistance to back up what the candle is actually doing, it just gives you more reason to actually believe why the candle is going to cause a reversal in the market in the favor that obviously you want to go.
Yeah, look, if everyone at the end of this goes away and just has a look at hammers and shooting stars and just looks at them within trend, you'll also see that generally when they are in the direction of trend, so let's say here we've already pretty much seen that this is quite a strong downtrend overall on the daily chart. You can see here we have our shooting star, and our shooting star reacted quite negatively, which is what we wanted to see, and it's gone down over time, bearish market, bearish moves, and it's actually broken that previous support and continued on. So sometimes it can be really good and really strong at getting those pullbacks in trends. And if you go through strong trends over time, you'll see that when you see these candles, whether it be a shooting star or a hammer, in the direction of trend, very strong signal. So I'd like to focus on them, of course, for channels today, but when they happen in trends, very, very strong signal as well.
Absolutely. It's always beneficial to trade in the direction of the main trend. So if the pattern is pointing that way, if we're in a very heavy downtrend over time and we do get a shooting star, it's just basically giving us an open gate to just continue on with the trend.
Great. So I want to go through a couple of quick trades that we were talking about last week so we can see how they're, panning out. So we had the gold trade that we were looking at, and we were looking specifically in an ascending triangle. You can see I've got that drawn up here, and we were talking about, I think it was about this point, whether it could break out, and if it did break out, what our target would be. So it has broken out. You can see it's broken out. Here was the candle that we'd be looking and entering into. We could buy, it's gone up, and it's just under price right now. So it's coming back down and testing our conservative entry, which was just here. So the price that we'd be looking for is we would always take 2/3 of the distance. And if you want to find out more about ascending triangles, I suggest you check out last week's video if you weren't there. And we can see here, this would be about take profit. So it got really close, but I'd still be aiming for this. And it's about 12.90. So if price gets to 12.90, that's where we would be potentially exiting this trade.
Absolutely, and there's a lot of good analysts at the moment calling that gold is going $13. So $1,300.
$13 would be pretty good.
$1,300. So
I'll tell you what, I'll get a truckload of money and I'll buy it $13.
Would be very happy with that.
That'd be like one of those anomalies, and the next day you wake up and it's listed back at $1,300 and you're pretty happy. So that was one that we were looking at last week, and I thought that was pretty interesting. I've also got another one. We're not again discussing this technique this week, but the US dollar yen is making some interesting moves. It's been very bullish for a long time. So you've seen the US dollar yen's been going up for, this is a monthly chart, so it's been going up since 2012, and that's partly due to them continuously printing money and all sorts of things to do with that. And I remember Goldman Sachs this year, I think it was, Tyrone, they came out and they said, we believe that the US dollar will continuously be bullish over the next 12-month period, and they had to renege on that about a month and a half into 2016. But the main thing I wanted to look at was what potentially could be happening over the next coming weeks with the US dollar yen. So we've got this kind of consolidation of price here, and it's forming what looks like to be a daily pennant. So again, if you want to look it up, you can see it online, but we will be covering this, I'd say, probably next week as well, because it hasn't happened yet. But I'd be looking for a break, hopefully to the downside, because it looks like we're in a bit of a downtrend, bearish trend at the moment on US dollar yen. And if you take what the distance of the pennant should be, it comes down to around this line down here, around this 104. So it's a massive projection. It's a big trade if it does happen. But it could be an interesting one, because if we check that out on a weekly, it goes back into our previous highs, so our previous resistance. So if it does happen, it's interesting that the market's already preempting. If this does happen, it makes a lot of technical sense. And a lot of patterns will do this.
Absolutely. And then if you look at them, when you look at it in isolation, it makes a lot of sense. But if you take it out to a monthly, and you can see what looked like a previous pennant on a monthly chart.
It was. It's on a weekly.
If you see that, there it is on a monthly chart. There's you could definitely draw a pennant, especially if you took this back to a line chart.
I'll take that back to a weekly actually, because this is one that this is probably the best pennant I've ever seen in the market. It wound up for ages, and because I know what Tyrone's going to say, he's going to say, let's take a look at the distance, and you'll see, look at that. It comes straight back up, and it almost took every single one of the pips that was available here. And this is a big trade, guys. So this is a 26 cent trade. So 2,600 pips.
It's a lot of pips.
2,006. That's a lot of pips. So I was in this one, but I did not have the. I didn't hold it past this. and that was my bad, I guess. But the overall trade, it was a huge trade, massive moves, and I would suggest that we pay attention to this pennant because you can see what happened previously. And you can see how accurate the take profit was on as well.
Yeah, when you get multiple reasons to take profit at a certain level, it just gives you a lot more confidence that it can get there because other people and bigger institutions, far bigger than any individual trader, are seeing the same thing. Okay, so when we're trading in the same direction with the same methods as the big institutional traders, of course our chances of success are going to be increased dramatically.
I'd like to also cover the one that we looked at last week, which was oil. We were looking at another ascending triangle. Go back and you can check that one out, and you'll see that oil has completed our 80% kind of rule on what we'd be looking for the take profit. So it's completed. We would have been buying just after the break here, after it takes out this potential shooting star here. And when it did break to the high, it moved very quickly. So you can see those patterns.
Our pending order stop there worked out quite well. So that was a very good example. Actually,
pending buy stop.
Yeah, all of our ascending triangles actually were quite good from last week, which showed a market that was actually on the move across many different sectors.
Yeah, and breaking
oil,
key
gold.
zones.
Absolutely, and you will find that when key zones get broken in gold and oil and indexes, everything seems to happen at the same time. So it is a good time to be trading.
I just wanted to zoom in and again just remind everyone of why we ended up taking it above here, and the reason why was because with this particular trade here, the problem is that it's a reversal candle, so a shooting star effectively, and it's showing us, okay, there could be selling coming in, but then we've got our overall pattern saying, no, it's going long. So it was just that conflict, and because I know these are quite accurate, I waited, and we had to wait.
Yeah, anybody who actually missed that last week, it would pay to actually go back and have a look at that because it's actually a very important point that Thomas has brought up. That even though the break was there on that candle, that shooting star basically did give us a lot of reasons to say, well, maybe we need to think about this and wait for that confirmation. So yeah, I encourage you to have a look at that because it does make a lot of sense.
I've just got Craig. He's sent in a question that somebody's been having a look at, and he did send this in the email as well. So I think it's about time that we get to the email list. Craig asked us to take a look at the euro US dollar, so probably one of the favorites of most people here. Very, very heavily traded pair. So he was just talking about, do we see anything on the euro at the moment? And I definitely do. I guess what I want to do is just break down the way that I'm looking at this particular pair at the moment. So if we change to, yes, I'm on a monthly chart. If we change to a line chart, I'd just like to draw up some quick resistance and support lines. So we can do that here. And then of course we've got our low here. Oh, just grab that. Then we can go to our weekly chart and we can start taking a look at that and refining our resistance and support lines. So we can bring our support down here, go to a daily, and what I like to do is just refine it some more. So we can go here, because of course it's becoming more relevant now that we get it correct, and we've got our support here. Now because it's broken out here, and again we're using a line chart, I'd probably just draw somewhere in the middle zone just to get that average through the whole thing, because you can see our price is interacting with this point. We've got two highs, we've then come down and tested this area, we've come down again, we've come down, test this area and tested it and broke it, and that's come down and at this level again. So that's how I draw that one. Now I'll change it to a line chart, bar chart, and then I'll go and break it down again. So what we've got here is, if we have a look at the euro US dollar, we can see here there was also some quite large wicks and price moved up quite a few times here, and when it came back down, it formed the resistance, formed some form of support here before it broke through.
Absolutely, and I think that's actually a really good example, Thomas, as to why going to a line chart to actually draw up your initial points of support and resistance is useful. Because although those lines, they don't look as clear and clear cut here, like if you were drawing these lines on this particular chart type, you would say, well, does that really make sense? But when you take it back to a line chart, it makes a lot of sense. So it is a really good idea to start with a line chart to get your defined areas nice and clear. because then it makes a lot more sense when you do move to a bar or candle chart, and you can see how the noise interacts with these levels.
And trading is not really necessarily about getting the absolute best price. We all want the best price, but we also don't want to be stopped out of our trades, and we want to have accurate percentages. So with something like this particular trade here, I'm pretty biased to the short on euro at the moment, and that's just because the overall pattern is short, and I like to trade in the trend. So it's come down here, come down quite strongly. It's come back up, and it's hit this point here, which was previous resistance, became support, and the first touch, I would be looking at this as being resistance. So I'd be looking at potentially some shorts here. Now, if I was placing that short, Craig, I'd be placing it here, and then I'd be putting a stop above the last swing. So a lot of traders will just say, okay, I'm going to put 50 pips on this. And if you just put 50 pips on this and sold it here, you'd be taken out. So what I was looking for is I always look for that visual representation to place my stops. So in this case, if I was placing a sell here, and it's not necessarily the best trade ever, but you could do it, I'd be selling at this point, and I'd be placing a stop above this high, with the idea of probably taking profit at down in these lows here. So it would work out risk reward ratio wise as well, because we'd have our 90-ish pip stop, and we'd have around 130 pip take profit. So a little bit over 1 to 1, about 1.5 to 1.
Absolutely. And just remember, when we are talking about our stop levels, we're going to be basically trading the correct contract size relative to the risks that we're trading, okay? So whether it's a 50 pip stop loss or a 70 pip stop loss should be irrelevant to your mindset, because if you're risking $100, you need to be adjusting your contract size to be only risking $100 no matter where the stop loss is, okay? Because the stop loss needs to be where the stop loss needs to be. It's not a money stop, it's a price stop. And it's very, very important that you don't rob yourself of potential profits by making your stop loss too close to the price action because you want to have a standard contract. Okay, don't be afraid to trade a 0.8 or a 0.7 if it means you can have the correct stop loss, because that's the most important.
Trading, like a lot of people when they start, they'll trade, let's trade a standard, and they'll continuously just trade a standard, but they'll have differing stops. So if you have differing stops, you have differing losses or potential gains. So inadvertently, generally you'll lose on those ones with the bigger losses, and you'll win on the ones with the smaller stops. So that's just how it works. And then psychologically, you're going to feel that loss, and you may revenge trade, or you may trade without actually making a good plan. So always remember, make a plan before you trade and stick to that as much as possible.
Absolutely. And I know trading a standard lot does appear very sexy, but it's not as sexy as trading 10 lots. Okay. And the only way you're ever going to be trading 10 lots is to have a very, very good mindset and very good risk management. So don't be afraid to adjust the contract size to whatever is required to fit in with your risk ratios. And it'll give you a lot more confidence that the trades will work out, and it'll help you become a successful trader.
Great. Well, I've got one other question just from the chat room at the moment, and it's just about going back to the euro pound. Someone was just asking. There was no conservative entry here. So that's right. There kind of was actually. If we have a look in at the 4-hour chart, so let's just break down this a little bit more. So we've got our top end of the channel, which we've drawn here, and then we can see the price broke above, and it actually did come down and test this area. So it tested back down to our resistance line, and we could have bought in at this point, or we could have bought in at the close of the high. So I probably would have waited till this candle had finished here. And if we zoom in a little bit more, I would have waited till this candle to buy. But if we had waited for the conservative entry, we would have got it, and we would have been 75 pips better off. And did it complete was the other question. It looks like it probably did, so let's have a look here. Oh, I probably should make this 100% accurate, so let's go here. And what do you know? Right into the tops. So that's pattern recognition for you. That's channels. Many different things you can do. Lots of different strategies you can build with channels. So I would recommend everyone checks that out.
And that chart we were just on, we were looking at, let's have a look.
What one?
One previous this one. Was that the daily or the time frame?
Oh, the time frame daily, yes.
If we also have a look at the break, there was another interesting point.
Did you want this one?
That is the one, yeah. Well, you could see as price was starting to build up to that, it's a little bit like what we were talking about earlier, where the waves of the market go in equal lengths.
Sure, okay.
And you can basically see that each length basically meets themselves. And
fairly close, yeah. So there's the length, and the way we're measuring this is from each major swing. So you can see those pullbacks. And you're talking over here as well.
I mean, the waves are just so clear cut, especially in channel type arrangements where channels are being building. It gives you a very clear distinction of where you want to put your stop losses and take profits. So they're really, really good to trade. Be mindful that channels are everywhere. They're in every time frame, and when you find one, trade it for your best possible chance of staying in it. And when they do break, don't be afraid to go in the direction as well, because there's just as much chance that you're going to make as much money breaking the channel as you are trading inside it.
So again, just like to thank everyone for joining us today. We'll be doing this again next week, so I'd like everyone to come along. And if you have any questions, feel free to send them to the email address that I'll put in the chat straight after. So appreciate everyone coming out. Tyrone and I are really enjoying this, and I hope you guys are too.
Brilliant. Thanks, guys, and we'll see you next week.